Hello everyone, John AG here, and I need you to stop scrolling because silver just got hit in a way that should make every stacker, every trader, and every I'll buy it later procrastinator pay attention. A few hours ago, silver looked like it was trying to hold itself together. Then, out of nowhere, it got slammed so hard that the move didn't feel like a dip. It felt like the market pulled the emergency brake at full speed. And here's the part that's going to mess with your head. This didn't arrive with one clean, obvious headline, no neat press release, no single breaking news banner you can point at and say, yep, that's the reason. Which means the real story is in the plumbing, liquidity, leverage, stops, and the levels everyone was leaning on. In a minute, I am going to show you the one level that decides whether this is a brutal shakeout or the first crack of a bigger reset. One quick thing, short and direct, I'm pushing back against copycat channels in this space, and I need your help. Subscribe and leave a comment, even if it's just urgent ag, so the algorithm knows you're backing original work. Alright, now let's get into what happened, because this move was not normal volatility. This was a crowded trade getting punished, and the speed of the drop is the giveaway. Markets can drift lower when demand is weak, but when price drops like a trapdoor opened underneath it, that usually means stops, forced selling, and thin order books are doing the damage. Here's the sequence that matters. Silver spent days compressing, higher lows pushing up, but upside progress getting weaker. That structure can look bullish to casual eyes because price is still rising, but to anyone watching momentum, it's a warning. The spring is getting tight and the release is going to be violent. In the hours before the smash, silver attempted a recovery. It pushed up, teased the crowd, and gave that familiar feeling. Okay, maybe the correction is done. That's how the market lures in late buyers. Then it hit a ceiling, stalled and rolled over. And once the key pattern broke, the market did what it always does when leverage is stacked on one side. It punished the most emotional money first. Now I know some people hate chart talk, so let me keep this practical. Patterns don't predict the future like magic. Patterns tell you where the crowd is positioned, where the crowd feels safe, and where the crowd has their stop orders sitting, and the market loves nothing more than walking price into the place where the most people are wrong at the same time. If you've been around silver for a while, you already know this is the asset that loves to embarrass people. It's hated, it's volatile, and it's thin compared to many major markets. One sharp push can trigger a chain reaction. That's why you have to separate your emotions from your plan, because silver doesn't care how confident you felt yesterday. Now let's address the question everyone keeps asking. What caused it? Sometimes the cause is not a story, sometimes the cause is positioning. If the market is loaded with leveraged longs, if stops are clustered below support, and if liquidity is thin, especially outside peak hours, price can fall far just to find real buyers. That's why after hours moves can look unreal. In thinner sessions, there are fewer bids. If buyers step back even briefly, price doesn't glide down. It drops through layers, and when that drop hits a pocket of stops, selling isn't optional anymore. It becomes automatic. So the first question you should be asking isn't, which rumor did this? It's, where were the pressure points? And the pressure points were obvious. A tightening structure, a trend line everyone was leaning on, and a support zone that had become a psychological crutch. And here's where the narrative games begin. The moment silver gets hit, you'll see the loudest voices claim this proves silver is a bubble, or proves silver is finished, or proves you should exit before you lose it all. They'll say it with certainty because certainty sells, but certainty is often a sign that someone wants you scared, distracted, and late. Because the truth is, silver has these events, it always has, and the people who win in silver are the people who can think clearly when the candles turn violent. Now let's zoom into the structure without turning this into a boring textbook. Trend lines are not lasers, they're zones. They represent areas where buyers have defended price before and areas where sellers have been rejected before. And when a zone breaks, it doesn't just change the chart, it changes the psychology of everyone watching. This is the critical flip. Old support becomes new resistance. People who bought at support and didn't sell when it broke often panic and sell on the retest. That selling pressure makes the retest fail. And when the retest fails, the breakdown becomes confirmed in the minds of traders, which invites more selling, more stops, and more momentum to the downside. That's exactly why the retest matters more than the first break. The first break is chaos, the retest is information. So here's your first cliffhanger. If silver revisits the lows and bounces immediately, that signals real demand. If it revisits the lows and hesitates, drifts and slips, that signals weakness. And if it revisits the lows and slices through without a fight, that's when you start preparing for a deeper correction and a longer grind. Now let me tell you what I did the moment I saw the smash. I didn't run to social media to panic. I pulled up two things, the chart structure and the physical market, because if you're serious about silver, you should never look at only one side of the equation. On the physical side, I immediately checked what was actually cheap and what was still overpriced in premium terms. Here's the funny thing about physical, different products behave like different submarkets. Sometimes bars are the bargain, sometimes coins are the bargain, sometimes older circulated silver is the bargain, and sometimes the product everyone used to ignore becomes the value play during a shakeout. In this environment, the surprising bargain has often been older circulated silver, lower premium relative to spot, easy to recognize, and sometimes priced in a way that makes you double check because you have been trained by past years to expect higher numbers. Meanwhile, certain shiny new products can stay stubbornly expensive even during a crash because premiums lag and supply chains move slower than charts. That's why you don't just ask, did spot drop? You ask, did the all-in price drop in the products I actually buy? Now, on the paper side, a lot of people try to hedge with options or short-term trades when volatility spikes. And look, if you know what you're doing, hedging can be a tool. But in silver, paper positions are playing on a field where overnight gaps and thin sessions can do damage you didn't plan for. If you're trading a popular silver ETF or a futures contract, you can be right on the big picture and still get wiped out by the timing. That's why I keep repeating, survival first. If your plan can't survive a violent candle, your plan isn't a plan, it's a wish. Now, when I'm looking at the chart, I like to flip between different time views because it changes what you see. On a very short view, you see the chaos, the waterfall candle, the bounce, the spikes. On a 4-hour view, you start seeing the real structure, where the rally began, where the support was built, and where the market decided to flip the table. And on a daily view, the shock becomes perspective. The same price that feels low today may still be historically high compared to where the market's at just weeks earlier. That doesn't mean the market can't go lower. It means you need to keep your perspective so fear doesn't hijack your decisions. Now here's the key overhead zone that matters. The trend line or channel that supported silver's run for months has now been challenged. On one chart view, it looks like price barely touched it. On another view, it looks like a clean rejection. That's why smart traders treat trend lines like zones. The exact line isn't the point. The battle area is the point. If silver can reclaim that battle area and close above it decisively, that's one of the cleanest signals that the correction is cooling. If it can't, then every rally attempt risks turning into a sell the bounce opportunity for trapped buyers. And yes, I am going to put a number on it in a general sense without pretending it is a perfect laser. Think of it as an overhead zone in the high double digits to around the psychological triple digit area. The exact level shifts with time, but the concept is the same. Reclaim, hold, and then build higher lows above it. Now let's talk Fibonacci retracements in the simplest way possible. Many traders pull a retracement from the base of the rally to the peak. There's a classic golden support zone where buyers often show up. During this smash, price tagged that general area and bounced hard. Does that guarantee the bottom is in? No, but it does tell you something. Real buyers were waiting there, and the bounce was aggressive enough to matter. This is where the market splits people into two groups. Group 1 sees the crash and says it's over. Group 2 sees the crash and says a discount just appeared. The difference isn't intelligence. The difference is time horizon and preparation. Now let's add another piece that most people miss: global pricing behavior. Sometimes you'll see regional markets maintain a premium even when the headline price drops elsewhere. That premium can tighten during panics, but the fact it exists tells you there's still real demand for metal, not just speculative paper flow. So the next time you see a crash and someone declares silver dead, ask them a basic question. If it's dead, why do physical premiums exist at all? Why do buyers still show up? Why doesn't the physical market instantly flood with sellers? Now let's talk about miners for a second, because a lot of people confuse silver's spot price with the entire ecosystem. Mining shares often behave like leveraged silver. That means they can drop harder in a smash, and they can rip harder in a rebound. If you're looking for opportunities, a smash can create bargains in miners, but it can also create traps. You want to look for quality, balance sheets, and how the stock behaves relative to the metal. Some miners get punished even when they shouldn't. Some miners deserve the punishment, and in a panic, the market doesn't care. It sells first and asks questions later. So if silver stays volatile, don't be surprised if miners look like a roller coaster. Now let me rewind the tape and describe what this looked like in real time, because the timeline is part of the lesson. First, you had that calm stretch, price trying to recover, candles looking organized, and the crowd starting to believe the selling was done. Then you got the first crack, a push down through the lower boundary of the tightening range. That alone doesn't always mean disaster. Markets break down and reclaim all the time. But what turned this into a real event was the failed reclaim. Price snapped back up, tested the broken area, and then got slapped back down. That's the moment the market says, no, you're not getting back in. And once that happens, psychology flips instantly. Confirmation buyers stop buying, late longs start dumping, and short sellers, who were too scared to enter at the top, suddenly feel brave. Because they have a clean invalidation point above. That's why I keep calling the retest the diagnosis. The break is dramatic, but the retest is where the market reveals intent. And yes, I'm going to annoy the purists for a second. I don't care if your trend line touches every single wick. If you need your line to be a perfect laser, you're missing the point. These are zones where participation concentrates. If price rejects in the zone, the message is the same. The market isn't a geometry class, it's a battlefield. This also explains why different chart types can make the same story look different. Sometimes the log view makes the move feel calmer because it scales percentage changes. Sometimes the regular view makes the rejection look cleaner. You don't pick the chart to be right, you use both to understand how different participants are seeing the fight. When I flipped to a broader view, one thing stood out. This run up into the highs wasn't just random pumping. It was built on repeated dip buying and a trend that trained people to assume every pullback would be saved. That conditioning is powerful. It creates confidence, and then the market breaks that confidence to remind everyone that confidence without a plan is just vulnerability. Now keep perspective. After a nasty correction, silver can still be sitting at levels that would have been celebrated as historic not that long ago. Volatility plays mind games. It makes you forget where you came from. It makes you treat still high as ruin simply because you saw a higher number last week. That's why the word decimated fits the vibe of this move. In its old meaning, decimation was a punishment used to restore discipline. Markets do something similar. They purge leverage, punish late chasers, and restore discipline. And they do it in the most humiliating way possible, so people swear off the trade right before it turns. Now some of you are thinking, what if that big run really was the top? What if that was the blow-off? Fair question. There are always analysts who can draw a Fibonacci extension or point to a round number ceiling and say, see, it hit the level. That was it. Sometimes those zones do matter. But a technical level is not a fundamental explanation. It's a behavioral marker. For a genuine long-term top, you normally need a shift in conditions. So ask, did we suddenly get a world where debt is shrinking, budgets are disciplined, and currency dilution stops? Did we suddenly get a surge of new mine supply that overwhelms demand? Did we suddenly get industry moving away from silver in a meaningful way? If those answers are no, then one violent candle doesn't automatically equal the end of the story. That said, the flush can continue, and this is where long-term trend tools matter. A lot of market participants watch the 200-day moving average as a rough health meter. When price is above it and the average is rising, the trend is generally intact. When price falls toward it, it can act like a magnet. And when price breaks below it and the average rolls over, that's when a trend transition becomes more plausible. So yes, a deeper reset is possible, and if it happens, it will test conviction. This is why I keep dry powder, not because I want crashes, but because I know silver has tantrums. If you have no dry powder, every dip feels like a disaster. If you have dry powder, dips become opportunities, and you can choose your timing instead of being forced by emotion. Now let's talk about why moves like this can happen on no news. In modern markets, the trigger can be as simple as a large order hitting a thin book, an algorithm scanning a level, or a fund reducing exposure after a volatility threshold is breached. Once the first domino falls, the rest becomes mechanical. Stops trigger, risk models adjust, dealers hedge, and you get an avalanche that looks like it was caused by something when it was really caused by structure. That is why you should be skeptical when you see a headline written after the fact claiming a single cause. The cause might be plumbing, not narrative. One more phrase people throw around is paper silver could go to zero. Don't take that literally as a prediction that the number on the screen becomes zero tomorrow. What it usually means is that paper claims can become irrelevant in a world where physical delivery and real scarcity dominate. In that world, the question shifts from what does the quote say to can you get the metal and what is the real world exchange value? We are not fully in that world yet. But nights like this remind people that paper pricing can behave in ways that feel disconnected from physical reality, and that realization is exactly what pushes some people to prioritize tangible holdings. Finally, keep an eye on the opening bell effect. Overnight sessions can exaggerate moves. Then regular hours open, liquidity returns, and you can see either continuation or reversal. Sometimes the open brings a second wave of selling because people react late. Sometimes it brings a violent bounce because the sell-off exhausted itself in thin conditions and real buyers step in when the market is fully staffed, so don't assume. The overnight print is the whole story. Watch how price behaves when the market is awake, and that's why I'm watching the same two things again and again, the defense of the low zone and the reclaim of the broken overhead zone. Hold the shelf, reclaim the ceiling, and the story can change fast. Fail to reclaim, and the market may demand more time, more pain, and more discipline from everyone involved. One small detail I'm also watching is how physical premiums behave after a shock. Sometimes spot drops, but physical doesn't follow immediately because inventories are tight and sellers don't rush to undercut each other. Other times, the premium compresses because dealers get flooded with orders and adjust fast. If premiums stay stubborn while paper whips around, that's a quiet sign that real demand is still there. If premiums collapse everywhere, that can signal genuine stress and liquidation. Either way, it's information worth tracking in real time for anyone stacking through chaos. Now I want to bring this back to the bigger picture because this is where people get tricked. When you stare at a one-night crash, your brain tries to rewrite the whole story. It tells you, see, it was all fake, that's emotion talking. So what would actually have to change for the long-term thesis to break? You'd need debt and deficits to improve meaningfully. You'd need monetary expansion to reverse in a durable way. You'd need supply constraints to disappear and demand to collapse. You'd need confidence to return to fiat and for real assets to suddenly become unwanted. Do you see that happening? Or do you see the opposite? Because as long as the broader monetary backdrop remains messy, as long as governments keep running the machine hot, and as long as silver's industrial role stays important, the bigger thesis doesn't evaporate just because the chart got violent on a Wednesday night. Now, I'm not here to pretend nothing can go wrong. Silver can correct further. It can retest deeper moving averages. It can create a long, sideways range that tests patience. It can make people quit right before it moves again. That's what it does. So here's your second cliffhanger. The most painful tests often happen right before the market makes the move that convinces everyone it is too late. That's why you don't need to predict the exact bottom. You need a plan you can execute. Here's a simple approach that keeps people from self-sabotage. If you're stacking physical, you can scale in. That means you buy some when fear spikes, you keep some dry powder, and you're willing to buy again if price dips further. You don't bet the entire plan on one candle. You build a position like a professional, not like a gambler. If you're trading, you wait for confirmation. That means you look for higher lows, reclaimed levels, and volatility before you risk big. You accept that you might miss the exact bottom because your job is not to catch knives. It's to catch trends after the market proves itself. Now let's address the bubble argument directly because it's going to be spammed everywhere after a crash. A true bubble is not just a fast price rise. A bubble is a price that becomes detached from the broader backdrop: currency expansion, scarcity, and real-world demand. One simple lens is to compare silver to the growth of money supply. The measuring stick matters. If the measuring stick is being stretched through ongoing monetary expansion, then nominal highs can be misleading. That's why comparing today's price to some old price without context is a trap. In past peaks, silver's ratio to broad money measures was often far more extreme. Today the run was hot and it needed a reset, but the idea that a single correction proves the entire multi-decade structure is finished is the kind of lazy conclusion that gets people wrecked. Now let's talk about the long base concept in plain language. When an asset spends years struggling under major highs, it builds energy. When it finally breaks out, it can run, but it rarely runs in a straight line. It surges, it corrects, it builds, and it surges again. The correction is not the end of the story. It's part of the story. And that is why it is dangerous to label one hard drop as the final top unless you can point to a real fundamental shift that justifies it. Now, to keep this script a style, I want to bring in a viewer-style question that I've been getting repeatedly. People keep asking me, John, should I be scared of paper price games? Should I ignore spot and just stack physical? Here's my answer. Paper price is the scoreboard the world watches. You can't ignore it, but you also can't treat it like it's the only truth. The physical market is slower, but it's real. If you're holding physical, your focus is ounces and long-term value. If you're holding paper, your focus must include risk management, because the paper world can gap, freeze, and whip around in ways that shock you. so the best approach depends on your goal, protection and long-term purchasing power. Physical makes sense, short-term trades? Respect the risk, or the market will teach you. Now let me drop something in creatively exactly the way I promised. If you want silver-related success stories, real people, real journeys, and how they built wealth through discipline, there's another channel linked in the description. Subscribe to it too and see how people stayed consistent and actually made it happen. Now let's talk about psychology, because this is where most people lose. The market's job is not to make you money. The market's job is to transfer money from impatient people to patient people. When price runs up, it creates greed. When it crashes, it creates fear. Both emotions make people make bad decisions. Your only defense is a plan, and your plan has to be built for volatility, not built for comfort. That's why I always say survival first. If your position size is so big that one overnight move ruins your sleep, you're too big. Scale it to where you can think clearly, because the market uses fear as a tool. Now I want to ask you 2 questions for the comments, and I want real answers. Do you think this was a pure liquidity and stops event, or do you think someone deliberately pushed the market to trigger a cascade? And when silver gets slammed like this, do you prefer buying physical, buying miners, or doing nothing and waiting? Drop your answers below. And while you're down there, if you're successful, if you've built something, if you've hit a milestone, share a quick win in the comments. It boosts morale for everyone watching, especially newer people who are getting their first taste of silver's mood swings. Now I also need to tell you something important. By the time you're watching this, a members-only video will already be published. It bundles the key updates in one place and goes deeper than I can go in a public video. If you want the in-depth breakdown and premium analysis, join the membership and watch it. It also shows me who is really following closely. And again, if you want faster alerts than YouTube can deliver, join the WhatsApp channel in the description. That's where I can drop instant notes when price does something crazy at odd hours, without waiting for a full upload. Alright, let's bring this back to what the crash actually means. For traders, it means risk is real and leverage must be respected. For stackers, it means the market just offered a discount, but you must be smart about how you take it. For everyone, it means the next move matters more than the last candle. The crash was the punch, the bounce and the retest are the diagnosis. So here's your third cliffhanger. If silver can reclaim the broken structure and turn it back into support, the people who panic sold will have to chase their entries back. And that chase can be violent. But if silver fails at resistance and rolls over again, we could see a deeper reset that shakes the sector longer than most people expect. That's why you don't marry one outcome. You watch the levels, you watch the closes, you stay flexible. Now, one mistake most people make right after a crash like this is overreacting to the first bounce. They see a bounce and assume the danger is gone, or they see a bounce and assume it's fake. Either way, they commit too early. The smarter move is to let the market show you structure, higher lows, reclaimed levels, volatility, and yes, that means you might miss the exact bottom. But you will also avoid getting chopped to pieces in the whipsaw zone where the market tries to confuse everyone. Now, one more thing. When the market experiences an aggressive flush, it often resets sentiment so hard that the next rally doesn't start when people feel confident. It starts when people feel exhausted. It starts when nobody trusts the bounce. And that distrust becomes fuel. So watch the sentiment, watch the silver is dead posts, watch the confidence collapse. Because when the crowd gets loud, the market is often close to flipping the script. So here's how we end this. If you want my play-by-play thinking, subscribe, quick and effective. Subscribe now, because the next move is going to trap the most people. If you want daily micro updates and voice notes, join the WhatsApp channel in the description. If you want the full premium breakdown, join the membership and watch the members-only video that is already live. And finally, leave a comment. Even if it's just our John AG, it supports the campaign against copycats. It helps the algorithm. And it tells me you're part of the core community. Stay sharp. Take care of each other. And remember, silver doesn't move to reward comfort. It moves to reward preparation. And the next chapter starts sooner than most people think.